and I want to tell you the secret to enjoying vacations. So, when I was younger, I would put together a vacation on my own. And I would buy the flights, and I would book the hotels. And then you show up, and you go to, let's say you go to the museum that you've always wanted to go to. And they're like, that's going to be 40 euros, which is like 50 bucks. And you're like, damn, is that for both of us? And they're like, no, that's a piece. I'm like, dang. And it just kind of claws at you to have to spend that extra money. But you've already spent $2,000 to get there. You're spending $200 a night at least on hotel. You know, and this is the reason you really go, right? But it gnaws at you. So the answer to this is to buy a vacation package where it's all included. So my wife and I have started doing these cruises with Viking where all your stuff's included basically. So every day I don't have to worry about should we go to this restaurant? Should we go to that museum? It's all part of it. And I paid for it months in advance, and it doesn't make any difference what I do on the trip. I'm not going to end up spending more money. So if you've ever been gnawed at by these decisions on vacation, there's your solution. Questions? Okay, so let's get back to this. We were talking about how financial leverage magnified the beta of the equity versus the beta on the assets. And we're going to do a little demonstration here. First of all, you may notice that this is a weighted average. We know that the beta of the asset is a weighted average of the firm's equity and the firm's debt. The beta of the equity and the beta of the debt. Now you guys have probably heard of beta of equity before. You may not have heard of beta of the debt, and we'll get to why that is here in just a little bit. But in reality, debt does have a beta. Now, what are the weights? E over D plus E. What do you think that is? What do you think E stands for? Equity. And what's D plus E?
Debt plus equity.
Yep. And so that's the total value of the firm or the value of the assets. And so basically, we've got two weights here, and when you add those two weights together, they have to add to 1. So E plus D over D plus E is equal to 1. That makes perfect sense. So that weight, E plus D, or divided by D plus E, is the proportion of the capital structure that is equity. And the second weight you see there is the proportion of the capital structure that is debt. Okay. If I give you a beta for debt, this is the equation you need to use to find the beta of the asset. Or you can use algebra and solve for any other thing here. I'm going to say this one more time. If I give you a beta for debt, this is the formula. However, most of the time we make the assumption that the beta of debt is 0. And let's explain why we make that assumption. So think about stock, how the value of the stock depends on the sales, the profits, that sort of thing. So it's like this, right? And so when the market's up, maybe the stock price is up. When the market's down, stock price is down. And so we can see how that works. But let's think about the debt. I've just bought a bond, and now the market takes a dump. I get my coupon. And then the market goes crazy and it's really high. I get my coupon. And then the market says it's just doing okay. I get my coupon. Do you see, as long as things don't get so bad that they are not going to make their debt payments in a timely manner, that basically the debt is not impacted by what's going on in the market. And remember, beta is a relationship between the price movements of a security and the underlying market. Well, if the security's price doesn't move any with respect to the market, then the beta of that thing is 0. And as a result, we would say that we may make the assumption, unless we're told otherwise, we may make the assumption that the beta of debt is 0. And when we do that, that entire second term just goes away, because anything times 0 is 0. So now what we can do is rearrange this equation to calculate the beta of the equity. And what it's going to do is tell us how the beta of the equity responds to changes in leverage. So here we go. We've got If we divide both sides by E over E plus D, that's the same as multiplying both sides by E plus D over E. Can we agree on that? Okay, and if I have E plus D over E, that's the same as E over E plus D over E. Have I broken any algebraic laws? No. And what does this thing do?
Cancels out.
Cancels out and becomes 1. So what we've got here is 1 plus D over E. What's another name for D over E? Some kind of ratio. What is it?
Debt to equity.
Yeah, it's a debt to equity ratio. And we know that 1 plus a debt to equity ratio is the equity multiplier. It's the equity multiplier. And so what we're really saying here is that the beta of the equity is equal to the beta of the asset times the equity multiplier. So if there's no debt whatsoever, that equity multiplier is 1, and the beta of the asset is exactly the same as the beta of the equity. But as I start to add debt into that capital structure, that equity multiplier starts to grow, and the beta of the equity starts to pull away from the beta of the assets. It's precisely the same idea as when we look at ROE. We know that ROE is just ROA times equity multiplier. And so in the same way as ROE starts to grow, as I add more and more debt into the capital structure given the same ROA, beta of the equity will continue to grow as long as I add debt to the capital structure, keeping the beta of the assets the same. And so I could have two companies that have the same underlying business risk that could have two very different equity betas depending on how they're financed. If one company has no debt whatsoever, their beta of equity would be equal to the beta of the assets. What if their debt to equity ratio was 1, which means the company is half debt, half equity? What would be true then? 1 plus 1 is how much? 2. And so we would see then that the beta of the equity would be twice the beta of the underlying assets. Does that make sense? Okay, now this formula that you see here on the screen right now, the second one, can only be used if we have the assumption that the beta of the debt is 0. How do I know that assumption's been made? I don't tell you the beta of the debt is something other than 0. If I don't mention the beta of the debt, you can assume it's 0. If I give you the beta of the debt is 0.2, then you've got to use that, and you've got to use the previous equation. Does that make sense? Okay. So, we have been talking about, we're trying to figure out how to come up with the cost of equity, and we said there were two ways, the security market line and the dividend growth model or dividend discount model. So all this that we talked last time was all just about security market line and how beta and all that works. And now we're finally on to the dividend discount model, and hopefully you guys recognize this. It's equal to D1 over P0 plus G. What is D1?
The next dividend.
Yeah, the next dividend. What's P0?
Current price.
Current price. What do we call that fraction D1 over P0? There's a name for it. I'll give you a hint. It starts with the word dividend.
Yield.
Yeah, it's the dividend yield. And we know total returns are equal to the dividend yield plus, where are the two ways we make money on stock?
Capital gain.
Yeah, so the second part has to be the capital gains yield, but it's also the growth rate of the dividends. It's also the growth rate of the dividends. And so, and they probably taught you this in Fin 380, but it bears repeating. If a stock pays continuously growing dividends, then the price grows at the same rate as the dividends. If the dividends are growing at 10% per year, the stock price grows at 10% per year. And that's because of this equation here. We know that G must be equal to the capital gains yield in order for us to get our total return. Now, how can we estimate dividend growth rate? Well, we could either do a historical average. For instance, if it's $1 2 years ago and then it was $1.10 and now it's $1.21, we would say that that's an average growth rate of 10%. The other way we can do it is to take B times ROE. We know what ROE is. What's B? It's got two different names.
Retention ratio.
Yeah, it's the retention ratio or the plowback ratio. It's the retention ratio or the plowback ratio. So we know that net income is equal to dividends plus addition to retained earnings. If I take everything here and divide by net income, then this thing becomes 1. This thing becomes the dividend payout ratio. And what's this thing? I'll give you a hint, we were just talking about it. Oh, y'all are bringing me down. It's the addition to retained earnings divided by net income. What did we say B was? Mr. Barentine.
Retention ratio.
Retention ratio. Retained earnings, retention. This is the proportion of the net income that we retain. And so that's why it's the retention ratio. So this is B right here. It's the retention ratio. Or plowback. Any idea why it's called the plowback ratio? Anybody here come off the farm? I'm the only one? Okay, so here's the deal. At the end of the season, you have harvested all the grain, and you're left with stubble and crap in the field. We come along then and we plow that stuff back into the earth. What happens to that stuff that we plow back under, the stubble, the roots and whatnot? Does it just stay there?
Breaks down and
Yeah,
decomposes.
it breaks down, decomposes. And what does it do to the soil for the next crop?
Fertilizes.
Yeah, it actually fertilizes for the next crop. So that's why we call this the plowback ratio, because this is the money that's left over that we're plowing back into the farm to promote future growth. So that's why we call it the plowback ratio. Okay, now, retained earnings are part of the equity of the firm. Does that sound right? So we've got the liabilities, and then down here we've got the common stock, additional paid-in surplus, and we've got the accumulated retained earnings. Those things are a part of equity, and therefore the return on them is the ROE. And so if I want to find this growth rate, it turns out I can just take that retention ratio, multiply by ROE, and it will give me the growth rate. Now, the growth, in fact, this is, you guys may recognize it being really close to the sustainable growth rate. You guys remember the sustainable growth rate formula? Oh, wow, you guys don't remember squat. Sustainable growth rate is equal to ROE times B, which we already have, divided by 1 minus ROE times B. These ideas are closely related, but for purposes of this class, how you're going to estimate that dividend growth is by taking the plowback ratio, multiplying by the ROE. Now by the way, this looks really simple compared to the security market line, and it is. But the problem is this, it only works for firms that have continuously growing dividends. It's the only kind of firm that it works for. It doesn't work for anything else. Now the question is, are there a lot of those firms out there? And the answer is not exactly. What we see when firms pay dividends do this while I'm talking. Okay, so what we see is we said dividends were sticky, and they'll stay the same for a while, then they will get raised. And then they'll stay the same for a while, then they'll get raised. They'll stay the same for a while, and they get raised. If you're at a firm like an electric utility, what you may notice is that this could be approximated as constant growth, and you might get pretty close. Are there any firms that actually grow in that exact manner as this formula would tell you? Probably not. And if there are, they're that way by design. And they won't be able to do that continuously because at some point something will happen. Even the best companies have troubles eventually, and they won't be able to maintain that. Okay, so that's the downside to this thing. It doesn't work for firms that with dividends that aren't growing at a constant rate. Now let's assume that I give you enough information. In fact, let's start by this. If I say the beta is this and the expected return on the market is this, which are you going to use? Security market line or the dividend growth model?
The security market.
Yeah, you got to use security market line. Now, if I give you the price today and the dividend 1 year from now and the growth rate, you're going to be using this one. What if I give you enough information to do both? Do them both, and then what?
You just find the average or the
Boop.
program.
Now, why is that?
Uncertainty.
Yeah, they're both just swags. I think maybe you deserve a coin today, too. They're both just swags, right? And so now we've got 2 guesses at it instead of just 1, so we'll just take the average. Questions? Okay, now the cost of debt is considerably simpler to talk about. It's just the yield to maturity on the firm's outstanding debt. It's just the yield to maturity on the firm's outstanding debt. Now the problem is, in fact, it's quite easy if you only have one issue of debt outstanding, so one issue of bonds. Do you think there are many firms out there that just have one issue of debt outstanding?
Or not.
Probably not. And so what we're going to be looking at then is going to be a weighted average of these yield to maturities. So let's just do an example here. We're going to have 3 bond issues, B, A, B, and C. It's going to be the number of bonds, 10, 1,000, 100, and then the bond price. Let's say this one is selling for 950. By the way, what's the face value of a bond? Typically, unless I tell you otherwise, you always assume the face value of a bond is how much? 1,000. That makes this a discount bond, right? Okay, so let's make the math here easy and say this one's selling at face value. We would call that a par bond. And then let's say this one is selling for 1,050. What kind of bond would we call it?
Premium.
Premium bond, very good. Okay, so now I can figure out the market value outstanding for each of these. I've got 9,500 here, and I've got 1 million here. And down here, I've got 105,000. If I add all those together, I come up with 1,114,500. Does that sound right? Okay, now if we're going to figure out the weights for each one of these, how would I go about doing that? For this one right here, what would I do, Mr. Captain Barentine?
Divide the market value of the issue A by the total of all the bonds.
Let's see, Mr. Roy, how would I do this one to get the weight?
Same thing, market value of that divided by the total market value.
Okay. And then Mr. Hong, how would I get this weight? Same thing. Tell me a number. What number do I write on top?
5,000.
Very good. And what number do I write on the bottom? 1 million? This one right here? Yeah. Okay, so now I have all the weights. Finally, we can look at the yields to maturity for each of these. And this one is currently yielding 7%. This one's yielding 6%. And this one's yielding 5%. How would I go about figuring out the weighted average yield to maturity?
1 times the
Yep.
maturity.
We're going to take the weight times the yield to maturity for each one of these. I'm going to store this in location 1. I'm going to store this in location 2. I'm going to store this in location 3 on my calculator. And then what will I do?
Just recall 1 plus recall 2 plus
Yeah.
recall 3.
Exactly. So we're just going to, and I'm not going to walk through that map. And in fact, if you guys want to take a picture of that or whatever and try it for yourselves later, I couldn't even tell you what the correct answer is though. So, you'd have to ask me if you got it right. Okay, now, that makes it really easy that we're just using yield to maturity. Now, I would tell you that yield to maturity isn't exactly correct for the cost of debt for a firm, and here's why. How often do bonds pay coupons, typically?
Fairly often.
Fairly often, oh my goodness. You guys have had Finance 380. Semi-annual, how often is semi-annual? Twice per year, right? And we know that yield to maturity is an APR, which is the sub-period rate times the number of periods per year. So let's say it's a 6% yield to maturity. That means it pays 3% and then 3%, right? What's the effective annual rate of that? It's going to be something actually higher than 6% because of compounding, right? And so my personal philosophy is that we should be using the effective annual rate. But I have been overruled by 60 years of finance scholars, so yield to maturity it is. This is what we're going to use. Questions? Okay, now keep in mind though that our true cost of debt is not the same as the yield of maturity because of the tax deductibility of interest. And as a result, that means we're going to need to multiply this yield of maturity that we calculate by 1 minus T sub C. What does T sub C stand for?
Corporate tax rate?
Yeah, it's the corporate tax rate, and it's the marginal corporate tax rate. And so we're going to throw that in there. Let's see. Okay, I think that's everything I wanted to say about this slide. Any questions? Okay, so here we have the weighted average cost of capital, and you guys have already seen this. Mr. Bardwell, you doing okay?
Yeah.
Look like you might be having a stroke there. Oh, okay. If you are, let me know. I'll call 911. By the way, if something freaky happens, you always call 911. If the ambulance comes and checks you out and they don't take you to the hospital, there's no charge. So I'm always, students are like, no, don't call the ambulance. I'm like, well, if you're not dying, they won't charge you anything. Okay, back to the story. Weighted average cost of capital. We just got through talking about this in the last class. Do you guys remember this? Yeah, we got through talking about it in the last unit, right? Unit, we talked about this. So I'm not going to spend a lot of time going over this. I will tell you one thing. Notice that this R sub debt is the same as this yield of maturity that we've been talking about. That is the before tax cost of debt. When you multiply it by the 1 minus T sub C, now you've got the after after-tax cost of debt. Read the problem carefully, because I might give you the before-tax cost of debt, in which case you need to multiply by 1 minus t, or I might give you the after-tax cost of debt, which means you don't need to multiply by 1 minus t sub c. So just as it was with, what was the last thing we talked about that's like that? Oh, the market risk premium versus the expected return on the market. Always got to read and make sure and know which one of those that you have. And here is a really silly example, so we won't even work through that because you guys are well above that. But now let's talk about the risk of the project. Remember, what we're doing here is trying to come up with a rate that's appropriate for our project. And it turns out if our project is the same amount of risk, same level of risk as the overall company, then it's perfectly fine to use the company's weighted average cost of capital as your discount rate for your net present value analysis. Now, let's talk about things that are just as risky as the rest of the company. Nissan. Nissan is a Japanese car company. They build this really boring car called the Altima. Assume that the demand for Altimas was such that they thought they should build another factory for that. If they're going to build another Altima factory, there'd be nothing wrong with them using their weighted average cost of capital. It's overwhelmingly what the company does, make these boring cars, and so that makes perfect sense that you could use the weighted average cost of capital. But they came out with this vehicle here in the last couple of 3 years called the Nissan Ariya. Are you guys familiar with that one at all? It's an electric car. I totally understand why you're not familiar with it, because it sold so poorly that this is its last year in the US market and it's only been out like 3 years. Okay, so it's an electric car. Now, there are some risks inherent with electric cars that you don't have with regular cars. For example, let's talk about physical risks. When you've got a battery-powered car, where do they put the battery? Yeah, it's at the bottom. In case you're an engineering or a motorhead person, basically that's so you can have the lowest center of gravity, improves the handling of the car. The car doesn't want to tip over when you go around corners. And so it makes all the sense in the world to put the battery down low, which means that you're basically sitting on top of the battery. Now, what else do we know about the batteries that they use in these electric cars? Have you guys seen these Teslas on YouTube? What do?
Catch fire.
They catch fire. They catch fire. Now, I want you to follow the bouncing ball. You're sitting on top of the battery. The battery catches fire. Talk about your chestnuts roasting on an open fire. This is a dangerous situation. Now, that's physical risk. Mr. Bardwash thinks that's a bad joke, and you're right. Okay, so that's physical risk. Let's talk about the financial risk, though. Do we know, truly, what the demand is for electric cars? No, why not? What has distorted the market for electric cars? I'll give you a hint. One of them's coming. So tariffs is one thing, but even before tariffs, we had subsidies, right? So we were paying these rich goof-offs $7,500 to go buy a Tesla. So the market was distorted. There was more demand for electric cars than there should have been because the price was lower than it should have been. And in fact, the estimates as that I read this morning said that now that the subsidies going away, the demand for electric cars is estimated to fall by 1/2. Oh yeah, that's big. Now, is that a real financial risk? Yes. Is that a systemic risk? Yeah. In fact, it's going on around the world that governments are dropping these subsidies. So, what am I telling you? It's a riskier project to do the Ariya than the Altima. Therefore, if you're building a factory to do the Ariya, what should be true about the discount rate you use versus the discount rate you use for the Altima? Oh, It's got to be higher, right? Risk and reward have to go together. This thing's riskier, so we've got to use a higher required rate of return. And so we say, well, wait a minute, how are we going to do that? Well, the best way is to find a pure play company that's doing exactly what your project is, and then use their weighted average cost of capital for your project. So I used to would have asked, tell me the name of a pure play electric car company, and you would have said, Tesla. Only the problem is now Tesla is not a pure play electric car company because they've also bought this Solar City whatever that was being run by Elon's cousin, right? And so we can no longer use Tesla, but we do have Rivian, which is still a pure play EV company. I think Lucid is still a pure play EV company. I'm not sure if they're publicly traded or not. But you can go out and find these, and you could look at their weighted average cost of capital and use that as your discount rate. So that's the best scientific way to do that. But how often is it that you think that you actually find a company that's doing exactly what you want to do and nothing else?
Rare.
Pretty rare. Pretty rare indeed. And if you're doing something new, like building a quantum computer to run AI to develop cold fusion, do you see that there's nobody else out there, at least nobody publicly traded, that's doing exactly that? And so you can't find a pure play company for many of the things that we want to do as a company. So how do firms handle that? Well, a lot of times they have this bump up, bump down system. And so they'll say, well, our overall cost of capital is 9%. And so if it's a risky project, we'll bump it up to 12%. If it's a safe project, we'll bump it down to 6%. So they go plus or minus 3%. Now, that sounds reasonable. It sounds better than using a single cost of capital, except for it leads to what we in industry would have called pissing contests. And so this is your industry term for the day, pissing contest. Here's what happens. You get everybody in a room, and you've got two kinds of people in the room. You've got honest, naive people, like I was, and then you've got people who've been playing this game for a while who have no regard for the truth. We'll call them everybody else. And so what happens? All these people who lie through their teeth are going to claim that their project is super safe. Why?
That's what the market likes to hear.
Okay. Well, if this is just a meeting amongst our company, the word's never going to spread outside this room. We're simply making this discussion to figure out whether your project needs a bump up or a bump down. So let's work at this from the other direction. Do you want your project to be accepted or rejected? Accepted.
You want it to be accepted.
Yeah, if it's yours, you want it to be accepted. So if you have a net present value analysis, what's more likely for a positive NPV, a low required rate of return or a high one? Yeah, you want to get it low. And what kind of project gets a low required return? A safe one. And so you have these people that go in there and they've got this crazy project, but they're like, oh, no, it's really safe, because they want to get that low required return so their project will get accepted. On the other hand, I walk in there and I say what I think mine really is, which is average. But because these people are lying, they're going to get the funding. I'm not. And so that's what we see happening in the real world. Now, how do you handle this? Don't lie about your own project, but be prepared to call out the other people. Dave, where did you get that? That's ridiculous, right? Everybody knows that this process you're talking about is extraordinarily risky. Why would you sit here and tell us that it's safe? But don't lie about your own project. Questions? Okay. Now, let's see a common fallacy that even Fortune 500 companies make. And that is the fallacy of using the same discount rate for every project at the firm. And that is the firm's overall cost of capital, also known as the weighted average cost of capital. And so that's what that black line that's horizontal there is all about. On the horizontal axis, we have the beta of the project. Remember, beta is a measure of systematic risk. This is basically that beta of the assets, the beta of the underlying assets for this project. And so we should be able to feed that into the security market line and come up with a true required rate of return for the project. And that security market line is the blue line. And the security market line, we would accept anything above the line because we know it's returning more than its required amount. And we would reject anything below the blue line because it's not returning enough. And so if we were making decisions rationally, we would be using the blue line, and we would be rejecting, or we'd be accepting the project on the left and rejecting the project on the right. However, if we're using the weighted average cost of capital, we end up rejecting some safe projects, ones that are greater than the security market line, but are lower than the weighted average cost of capital. Those are still profitable, positive NPV projects, but we're rejecting them because they're not returning the weighted average cost of capital. We're also accepting unprofitable, high-risk projects, ones that return more than the weighted average cost of capital, but are below the security market line. So we've got two kinds of mistakes here. The one on the left, we're leaving money on the table, but there's no evidence after the fact that you've done it. Right? What about the one on the right? You've accepted a bad project. Now there's evidence for everyone to see. And this leads to a situation where the assets of the firm continually get riskier and riskier because we're rejecting safe projects and taking on risky projects. And there's nothing wrong with taking on risky projects as long as they return enough to compensate you for that risk. But this project is not. Anything in that little wedge there is not going to be returning enough to pay for the risk. And so what we see over time is that the risk of the firm increases, the risk of the firm's assets increase if you do this, but the returns don't keep up with it. And so you're actually destroying shareholder value by doing this. One thing, you're walking away from projects that could have increased shareholder value. On the other side, you are accepting projects that destroy shareholder value. Oh, and by the way, your assets keep getting riskier and riskier and riskier. Now that you've seen this, it looks incredibly simple, and you think, why in the world would anyone do that? I worked at Walmart headquarters, 1993, my summer or my Christmas vacation from school. And I actually, they told me, they said, we've got MBAs here from Harvard in our finance group. And I said, why would I care? I'm just an engineer, right? I didn't care. Move forward, probably 2010 or so. I am up in the dean's office here, and I meet one of our former graduates. And he is now vice president of the customer experience at Walmart. Now, what does that mean? He's responsible for the checkout, how you check out, right? That's one of the things he's responsible for. And so you've got your garden variety check stands, which with the person that goes beep, 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 right? That might be an average risk project. And then you've got self-checkout. What do you think a self-checkout stand is risk-wise versus a manned checkout stand?
It's higher risk because there's higher theft.
Yeah, it's higher risk because of the theft. Now, Walmart actually was talking about, and I think they'll eventually get there, where every single item in the store has an RFID tag. What does RFID mean?
Radio, some frequency, something.
Radio frequency. What does ID usually mean when I say show me your ID?
90, yeah.
And it's radio frequency identification, right? And so these tags, they pass through a transmitter, and the transmitter basically interrogates it, and it bounces back, kind of like radar, and the message that comes back from this chip tells you, I'm a roll of paper towels. I sell for $1.39, that sort of stuff. And so the idea is that if you put an RFID tag on every single item in the store, you don't actually have to pass through the checkout at all. You just throw all the crap in your cart and you just push it out. And as you're pushing it out, these readers on either side of the door go beep, 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 and add up all your crap, and then they charge your account on the way out. And they know who you are because you've got one of these credit cards with the chip in it. Got one of these that you can tap to pay, or you've got your Apple Watch on or your iPhone. Of course, you had to set up an account beforehand so they'll know, exactly how this all works, but that's the idea. Now, what does the risk sound like on that?
Sounds good.
Sounds lower if it works.
If it works, that's the key. If it works. How long do you think it would take smartasses to figure out that if I just managed to place like a little metal flower pot next to the RFID tag on the big screen TV, do you see where it could go terribly wrong? The risk is higher. Now, so I'm talking to the guy from Walmart about this, and so he's telling me about the customer experience. I'm like, oh, I said, well, I'm just a finance guy. I wouldn't have any, grand advice for you. And he said, oh no. He said, every project that we do has to go to the finance people to get approved. I said, what's the approval process? He says, well, the project has to clear the hurdle rate. I said, what's the hurdle rate? He said, well, it's the firm's weighted average cost of capital. Walmart, biggest civilian employer on the planet, at least at that time, was doing this. My old employer, Halliburton, was doing this. 1994, that number was 11.9%. Anything that returned more than 11.9% got accepted. Anything that returned less than 11.9% got rejected. They're both making the same mistake, rejecting the safe, low-risk projects that are profitable and accepting the high-risk projects that may not necessarily be. Questions? Now you know that you have a better education than a Harvard MBA, because after all, it was those crackers that came up with that, right? Those people down at Walmart, the Harvard MBAs, they're the ones that said about the hurdle rate. Okay, so we've talked about the weighted average cost of capital, and I want to tell you that if you're using it, whatever rate we're using, if it's a weighted average cost of capital, the bump up, the bump down, security market line, whatever it is, when we throw that into a net present value analysis, do you think we'll need to include cash flows for interest in our net present value analysis? You guys have been trained on NPV, right? Do you ever include interest as a cash flow? The answer is no, and here's why. The weighted average cost of capital, or whatever the required return is for the project, accounts for the costs of financing. So you're never going to see interest cash flows in a correctly done NPV. You're never going to see dividends. You're only going to see the required return as your cost of financing. So I better not ever see any of you putting interest cash flows into your projects, regardless of how the projects are financed. Okay, now let's talk about flotation costs. Hopefully you guys remember when we talked, or when you guys learned about bonds, they told you about something called a sinking fund. Did you guys hear about a sinking fund for bonds? No? What have they been teaching you guys? Oh my goodness. So sometimes I'll ask my students, And they'll say, no, we've never heard that. And then I'll go talk to one of their professors, and they'll actually like pull up the video where they talked about it. And they're like, they were just sleeping or high, right? Okay, so the sinking fund is the fund that the borrower puts out there, puts money into to buy back the bonds. So you're going to sink the bond issue. What's the opposite of sinking? Floating. When we issue a new bond issue or a new issue of stock, we say we are floating the issue, and the costs of doing so are called flotation costs. The cost of doing so are called flotation costs. And who gets the money? The underwriter of the issue, also known as an investment bank. If I tell you to picture an investment banker in your head and ask you what kind of car they drive, what are you picturing?
Top of the line.
Top of the line, you're being a little generic there. Name a brand.
Audi.
Oh, maybe a really unsuccessful one. Turns out that the Wall Street bonuses for investment bankers, the day those come out, is the biggest sales day for Ferrari in their New York City dealership. Biggest sales day, because those guys are taking their bonuses down there and buying Ferraris. Now, if they're buying Ferraris with their bonuses, what kind of money do you think they're making? Really good money. Where do you think the money comes from? Flotation costs. These are an expense that companies pay in order to get their stocks or bonds out there in the market. Now, one thing you need to know about flotation costs is that they are higher for equity than for debt. And to understand why that is, we need to talk about the flotation process. It works like this. The investment bank goes out and actually buys the stock. Let's call it stock. Buys the stock from the company, and then they turn around and sell it to their retail investors. So pension funds, mutual funds, fat cats, those are the kind of people who get the stock in an IPO. Now, in order for the investment bank to make any money, they have to buy the shares for this amount and sell them for this amount. And so that difference is how they get paid, and that's your flotation cost. For stocks, it tends to be around 7.5%, which sounds small perhaps until you get to thinking about a $1 billion IPO, and then suddenly you realize these people are making a boatload of money. Okay, now why would it be cheaper for them to do this with bonds than with stocks? And the answer is something called inventory risk. Remember I said they buy it and then they turn around and sell it? Well, in the meantime, they're holding all of those securities in inventory. Now remember that bonds have a fixed set of payments, and we've got a pretty good idea of what the yield to maturity should be. And so the risk that they're going to face on the value of these assets while they're holding on to them is much less with bonds than it is with stock. By the way, does stock have a fixed set of promised payments? No. Do we even know what the future growth of the stock's going to be? No. And in fact, most of the time, what we find out after the fact is that the company has kind of cleaned up their financials to make it look better right before the IPO. It's so interesting to watch because almost always the first quarter after the IPO, you'll see them, they're like, oh yeah, we had a rough quarter, and then they'll even have to take some charges and whatnot. Well, it's because they overstated prior to, right? So they're kind of cleaning up the cleanup on the backside. So there's more risk with equity. We know far less about what those future cash flows are, and people's concept of those can change. And what does that mean for the value of the stock? It means that the value of a stock can fluctuate a lot more rapidly than the value of a bond. which means that I could buy these shares for $17 thinking I was going to sell them for $20 a share, when in fact, by the time I turn around to sell them, the market's only willing to pay me $15 a share. And so there is even the possibility of losing money. There was an example of this. This has been maybe 15 years ago. There was a company called Vonage. Have you ever heard of Vonage? Vonage does internet telephony. They were the first people to come out with it and try to make a company out of it. And when I saw this, I told my wife, I said, that's really stupid, because almost anybody can replicate that business model. They have no sustainable competitive advantage. And as soon as I saw that, I said, you know what? I'll bet they're going to take that public as soon as they can before people figure out that it's a dog. And sure enough, they go IPO, and apparently investment bankers hadn't picked up on the same thing I had, because they paid $17 a share, let's say, thinking they were going to turn around and sell it for $20, but instead they end up having to sell it for $15 and took a huge loss on that. That's why the flotation cost for equity is higher than the flotation cost for debt, because it's riskier for the underwriter. It's riskier for the investment bank. Okay, now, here's the problem. Well, we'll get to that in a second. But what do you need to know about flotation costs? I've even seen this in a finance textbook where people say, oh, well, we just add our weighted average flotation cost to our weighted average cost of capital. That is so wrong. That is wrong, because the flotation cost actually happens at time zero as a real dollar amount. The weighted average cost of capital is an ongoing cost of financing, but the flotation cost happens as a dollar amount at time zero. So we never just add it to the weighted average cost of capital. We always count it at the beginning as dollars and cents. So if we had to go out and raise money to build a factory, not only would time zero be the factory, it would be the factory plus the flotation cost. That would be our expense at time zero. Say
I
again?
think in the textbook, the example it did for this, I think they found the NPV first without the considering flotation, and they subtracted it from their final NPV.
Yeah, and I'll give an example of that
Okay.
when we get, and the reason they do that is, did it change it from being positive to being negative?
Yes.
Yes. And so basically it's illustrating that flotation cost is important because it can change decisions. And that's the only reason they did that.
Okay. But if we're doing the calculation, we need to include it as our time zero cash. as
Yeah, you
part
need
of
to
the
add
time
it to
zero
your
cash
time
flow.
zero cash flow.
Okay.
And so it makes it even more negative, right? If I was spending $1 million on a factory and I had $100,000 worth of flotation cost, it would be minus 1.1 million at the beginning.
I guess it wouldn't change no matter which way you add it, it wouldn't change the number.
Okay, so you can either think of it as a positive cash flow out or a negative cash flow in. You know, whatever your sign convention is. Which, by the way, you can choose as long as you always get it right? As long as you always do appropriately. Okay, other thoughts before we move on? So, one of the problems that we see here, remember that group of people that I said was lying about how safe their project was? Those same people will always say, oh, but wait a minute, my project's going to be funded with debt. Therefore, I should face lower flotation costs. And the reason they do it once more is because they want it to be more likely that they're going to have a positive NPV. When you hear someone making that argument, you always say no. Whenever we calculate flotation costs, we always assume, number one, that we are already at our target capital structure. Do you guys remember the trade-off theory? So once we're at that target, we don't want to move away from it. And so we're going to assume that whatever project we do, we are going to issue debt and equity in the same proportions that we already have in the capital structure in order to maintain that target capital structure. Now, in the end, Might we go out and fund this one project with debt and the next one with equity? Yes. But we should not advantage projects that might get funded with debt versus ones that might get funded with equity. They would be disadvantaged. Okay, so that's what we're always going to do. And you'll have people say, well, wait a minute, why don't we just go ahead and just fund every project with debt then? And the answer is that you get farther and further away from your target capital structure. As a result, your expected cost of financial distress goes up and the value of the firm goes down. So we don't do that. Questions? Okay, so here is our weighted average flotation cost formula. You guys may remember those weights. You may recognize them. We have the proportion of the capital structure that is equity. We have the proportion of the capital structure that is debt. And we're going to multiply that proportion that is equity times the flotation cost for stock. And we're going to multiply the proportion of the capital structure that is debt by the flotation cost for bonds. And note, there is no 1 minus T sub C here. The tax treatment is identical for flotation cost whether you're issuing debt or equity. So don't get confused and throw 1 minus T sub C in there. And when we work out the math, that F sub 0 is our weighted average flotation cost. And it's going to be as either a decimal or a percentage. So if you put in F sub S and F sub B as percentages, it's going to be in a percentage. If you do them as decimals, it'll be in a decimal. Any questions? Should this formula be on your note sheet? Absolutely. Now, here's the final fun thing about weighted average flotation costs. If we have internal equity, and where do we say internal equity comes from?
From retained earnings.
Yeah, retained earnings. If I have enough addition to retained earnings to fund the equity portion of this project, my flotation costs for stocks are 0 because I don't have to go out and issue new stock to raise that equity. So I'll give you an example. Apple. You think Apple needs to issue stock to go out and make investments and stuff? Absolutely not. They're sitting on a boatload of cash, sitting on a boatload of retained earnings, and you see lots of companies that can be in that situation. And so if you are fortunate enough to be in that situation, then your flotation costs for stocks goes to 0, and that second part of the equation, or the first part of the equation, actually just goes away, right? Because the flotation cost for stocks is 0, means that whole first term goes away. So let's do an example here. And the numbers on this example are way out there. Like I said, the equity is about 7.5% from what we can tell. So your company is financed with half debt, which has a flotation cost of 5%, and half equity, which has a flotation cost of 15%. And the first thing we're going to do is figure out the weighted average flotation cost. Well, if it's half debt and half equity, that means each of those weights are 0.5. So I'm going to take 0.5 times the flotation cost for stock, which is 15%, gives me 7.5%. Then I've got 0.5 times 5%, which gives me 2.5%. And what happens when I add 7.5 and 2.5 together? Get 10%. And so my weighted average flotation cost is 10%. Now, we need to figure out what money number that correlates to so we can put the appropriate cash flow in our analysis. So how do we do that? Well, we need to do a little algebra here. We're going to need $100 million. But if there's a flotation cost of 10%, if I go out and just issue 100 million of new stocks and new bonds, so 50 million stock, 50 million bonds, how much money would I actually receive? 90! Because I have to pay the investment banker 10%. So what does that mean? It means I need to actually raise more than 100 million in order to be able to get the 100 million that I need. And so we need to figure out how much we actually need to raise. Well, we can say we know we're going to get 1 minus f sub 0 of the amount of money that we raise. And so the amount that we need has to be equal to the amount that we raise multiplied by 1 minus f sub 0. Now, we know how much we need. We know the weighted average flotation cost in percentage. And so what we need to do is rearrange that equation and solve for the amount to be raised. And when we do that, we get it's the amount needed divided by 1 minus f sub 0. So in this case, f sub 0 is 0.10, 1 minus 0.10 is 0.9. And so when I take 100 million and divide by 0.9, I get 111.11111 million. The ones just go on forever. That would be my time zero cash flow, not 100. It would be 111.11111. And then if anyone were to ask you, well, wait a minute, what were your flotation costs for that project? What would you do?
Subtract the 100 million.
Yeah, you would take the amount raised minus the amount needed, and that would give you the flotation costs in a dollar amount. Questions?
For treasury stock, if they want to reissue that, is that a different flotation cost? Or if they buy back and then don't actually destroy those shares?
Yeah, so now you're getting into some legalistic accounting stuff.
Okay.
Unfortunately, I'm just a lowly finance professor. Okay, so treasury stock, typically, how I have heard about treasury stock being used is that they use it to fulfill executive stock options. And so when you do that, then if the executive turns around and sells it, then basically the shares are back out on the market and there's no flotation costs for that. But you'll also see people issuing new shares for executive stock options. Well, you wouldn't have to do flotation costs for that because it's all being basically taken care of in-house.
Gotcha.
That's my understanding.
Okay. So they wouldn't take treasury stock and just try to release those as an issuance?
I have never heard of that.
Okay.
Now, I would be pleased for you to research this and come back and tell us what you find, but I've never heard of that. Okay, now, something that you mentioned earlier. In the book, first they work the project without flotation costs, and then they include them. Let's assume that we work this example without the flotation costs, and the NPV is $5 million. Would you accept or reject the project?
Accept.
Yeah, you'd accept it. Now, throw in your extra 11.111 million in flotation cost. Now your NPV is 5 minus 11.11 is minus 6.11 NPV million. Accept or reject? Reject. So that's the whole idea with that example, is that once we include these flotation costs, we may end up rejecting the project. And as a result, because they are real cash flows, we always need to include them. By the way, I'm going to say we always need to include them if I give you the information in the problem to solve for them, right? And so if you're doing an NPV analysis and I give you information for the flotation costs, then you darn well better include it. But if it's not there, then you can assume that there's zero. By the way, could a firm have zero flotation costs? Absolutely. What if you've got an all-equity firm with lots of retained earnings? Then in that case, any project they would undertake that was below the level of their retained earnings, they could just fund out of that, and they would have 0% flotation costs. And that is the end of chapter 12. Are there any questions? No? Okay, well, I will see you guys next time.